Deciding on buying a condo or co-op, in this video we're going to share with you the 4 differences in terms of financing. Coming up. Hi, this is Kai with the Kai Wong Team, helping you better understand everything you need to know about New York City real estate. Today I have Scott Nadler from the Loan Depot. How are you doing today, Scott?
I'm doing great. Thanks a lot for having me, Kai.
Thank you for being here. So tell us a little bit about yourself.
I am a mortgage loan originator, so I help people who are looking to buy homes or looking to help people who currently own a home and need to restructure their current loan.
So we want to talk today a little bit about buying a condo versus a co-op. Let's start at the beginning. What's the difference between a condo and co-op?
Buying a condo, you are buying real property. You will get a deed to that property, you'll get a title insurance policy, and you have ownership in that property. A co-op, you're buying shares in a corporation. You're not buying real property. In fact, at the closing, as you know, at a co-op closing, you will actually get a stock certificate that shows the amount of shares that you own in that corporation.
So buying a condo is, in a way, like buying a house. You own the actual real property.
Absolutely.
While buying co-op, it's like you're buying shares of Tesla or Apple, where you're just getting shares of the property, but you don't really own it.
That's right. The first step is costs. And when you're buying any kind of property, the first step is there are 3 buckets when it comes to the overall cost. The first bucket is the down payment. Co-ops, by and large, will require a 20% down payment. Condos, you're typically not restricted. Most condos will allow you to put 10% down. Some, in fact, can even allow 5% down. Second bucket is closing costs. Overall closing costs for any co-op under $1 million will be about $4,000. If it's over $1 million, there's a 1% mansion tax. So that's going to be 1% of the purchase price. So if it's a $1.2 million co-op, that's a $12,000 fee, plus the $4,000 in closing costs. And those closing costs do not include your attorney's fee, which can be $2,000 to $3,000 as well. For a condo, it's not exact science, but condos are typically, the closing costs, are typically around 3% of the purchase price. And the third bucket are the reserves, meaning how much money you have in your bank account after you've made the down payment and after you've paid the closing costs. A co-op will typically want to see that you have 24 months of mortgage payments plus your maintenance payment. So as an example, let's say your mortgage plus your maintenance is $5,000 a month. $5,000 a month times 24 months is $120,000. A co-op will want to see that you have that much money in the bank after closing. For a condo, you're not going to have that type of restriction. You could have 2 to 3 months of reserves, whatever the bank is going to look for. And typically a bank will look for somewhere around 3 to 6 months.
What's step number 2?
Step number 2, which we sort of touched on a little bit, is just qualifying, right? The one thing we didn't talk about is income. Banks and co-ops will want to calculate your debt to income ratio, your debt as a percentage of your overall gross income. Banks have their requirements, co-ops have stricter requirements. When we're looking at a client, we may tell them that from our perspective, they're qualified to borrow X, but if the co-op isn't going to approve them at that number, we need to have a conversation about it to say just because we can approve you doesn't necessarily mean that the co-op will be able to approve you.
Okay, and for condos, you don't have that kind of restriction?
They have debt to income ratio requirements, but it's simply the bank. As long as the condo doesn't have their own requirement for it, and most don't, then they're not going to be as restricted as they would be if they were buying a co-op.
So what's step number 3?
So step number 3 is really timing. For a condo, as long as the sellers and buyers have an agreement as far as when they want to close, you could typically close the loan within that time frame, which is typically around 60 days. For a co-op, the one unknown is we don't know when the co-op board will approve the loan. You and your team put together a co-op board package with the whole financial profile of that client. You submit it to a co-op board, and then we sit and wait. That co-op board can take 2 weeks to approve it. They can take 2 to 3 months to approve it. And then when we lock in an interest rate, we're locking in the rate for a certain amount of time, which is typically 60 days. So if we start the process with a client and we're talking about a specific rate, we may not want to lock in that rate because if the rate expires before the co-op board has approved them, that client would have to pay extension fees, and extension fees can be costly.
So at what point in time would you lock in the rate for a condo and also a co-op?
A condo, it depends on the market. So we're having an open conversation, we're not restricted. As long as we know when everyone wants to close, we can pretty much lock in the rate at any time. For a co-op, it requires a lot of communication between the real estate broker and the mortgage lender and the client. Once the commitment letter is issued, that's when we'll start having the conversation as maybe now is a good time to lock in the rate.
So what's step number 4?
In addition to getting a client approved for a loan, we look at the building's financials as well. So we'll look at their last 2 years of financial statements. We'll look at their budget. We'll look at their insurance. We'll look at a questionnaire. And we'll check on the financeability of that building. And a company like ours, we have 50 different lenders that we work with. So a lot of flexibility, and some lenders are less concerned about a building and more concerned about a client. So as long as the client qualifies, there oftentimes is financing available for any building, especially in New York, where real estate is very valuable. I think, and I say this all the time, you can never start too early. So I think when you start the process, understanding the difference, because you may start looking at different properties and not understand the difference between a condo or a co-op and fall in love with a specific property. But if you won't pass the co-op board, then it's irrelevant.
I say the same thing to my clients too. It's important to have a conversation with a lender to better understand what's your particular financial situation and what makes more sense for you. Like how long you plan to stay there. Does it make sense to go condo or co-op? Because, for example, if you're buying it to live in and later on you want to rent it out, co-ops are going to be a little more restrictive as well.
Right, absolutely.
Awesome. Well, thank you so much for being here today.
Thanks a lot for having me.
Thank you for checking out the video. If there's any other discussions that you wanted to have, please have it in the comments below. Let us know if you want us to cover anything else in a future video. If you're new here, consider subscribing. In this channel, we cover buying and selling tips, market updates, and neighborhood reports. So thank you for watching. See you in the next one. Bye.